Hi, Walter Wealth family. Great to be with you this week on our market update. Today is the last day of September, and I apologize for those of you that I a little scared a little bit last week about China. But the scare is not unwarranted. Everything I said last week is exactly as I said it last week on China, and you can see that we did actually have September, and we're almost at the yeah, we've closed now. And so we're down today on the Dow 546. It looks like the S&P is down for the month about 3%, and NASDAQ is down about 4%. I'm going to explain why NASDAQ is always a little bit different than the S&P and the Dow. But I do want to make a note that we expected September to not be great, and it wasn't. And so that's the reason. The jobless claims rose by 11,000 to 362 for the week ending September 25th. And that was versus an expectation of 335. So basically, economists are still getting it wrong, and we're still having more jobless claims coming in. We did have the Senate reach a stopgap deal overnight that would basically fund the government until early December, but Congress has got to pass something to avoid a shutdown. The lawmakers want to raise the debt ceiling by October the 18th. That's to prevent the U.S. from defaulting on its debt. But it looks like so far the Republicans are actually going to be fiscally conservative about this and not let them just blanketly raise the debt ceiling. Although I expect to fully tell you within a matter of less than 2 weeks, they've reached a deal and the debt ceiling is raised. Because unfortunately, nothing seems to be out of range. I was thinking about the psychology of this, and when you pass $8 trillion in legislative stimulus and the Federal Reserve $1.3 trillion a year, when you then come out with a bill that's 5 trillion or 4.5 trillion between its component parts, 3.5 and 1 trillion, two separate bills. So it's really 4.5, 5 trillion. Anything that we cut from there seems like a deal, but it's not a deal. 1 trillion is too much because we just spent $8 trillion, and it has hyperinflated our market, and the market is overbought. We're about almost 40% off of our high of Corona, and there's no economic fundamentals to support this. So we are still looking for an impending contagion impact from China. And as you can see, supply chains, if you look off the coast of California today, we've got the most amount of ships I think have ever been stagnated. And you've got a combination. You've got labor problems because the labor's not there because of the virus. And you also have them shutting ports down. The second largest port in the world was shut down in China because one person tested positive for Corona. So we got to get a handle on if we're going to be back to work and working, or if we're going to allow one person's positive result to literally shut down an entire port for a week. And this is why we have massive supply chain problems. To touch on why NASDAQ might have a bad day where the Dow and the S&P are positive, NASDAQ is mostly tech. When it comes to tech, investors are looking for profits and capital gains in the long range, long term. So as you start to see interest rates climb, bond yields climb, and as bonds become more attractive, let me be clear. I don't think bonds are a viable asset class for the next 20 years because the interest rates cannot go up because our debt is so high. So the Federal Reserve can attempt to raise interest rates all they want, but the truth is we can't afford to sustain anything above really I'm not going to say where it is right now, 25 basis points, but I don't see the Fed getting to a normalized 100 basis points, 1% rate in the next 20 years. I just don't see it. And here's why. Because as debt rolls off, we replace it with new debt. We don't pay off anything. We just write new paper to pay off the old paper. It's really a game. It's really MMT, modern monetary theory. And so the Fed is not interested in raising rates anytime soon. I don't think in the next 20 years we're going to have a normalized rate between 5 and 7% like we were used to. And so when bonds become more attractive, what happens is you have longer term prospects that become worth less money because their profits are on the long term. So as it relates to NASDAQ, profits on tech companies are for the longer term and capital gains once the technology takes off and it becomes an actual usable tech. So what happens is when bond prices and yields rise as inflation pushes them up, then tech investors say, maybe I don't want to wait 20 years or 10 years or 5 years to get a capital gain from this thing. Maybe I'll sell it and move some money into bonds, especially now that the market seems very volatile. So that's why you see NASDAQ not performing the same as the Dow and the S&P. Of course, the Dow is our 30 industrial stocks, and it gives us a really good indicator of what's going on with the industrials. But the S&P obviously is the broadest spectrum that we have with the 500 across all sectors, and that's what we really use as a broad market index across the world. So we are down for the month of September. I still do have concerns about China, but I want you to understand, because a lot of clients called the office after my update last Tuesday and were really concerned about the fact that I was talking about BlackRock specifically is very heavily invested in China. BlackRock is the largest asset manager in the world. They have their hands in every pie that is worth holding. And China obviously is now the largest GDP producer in the world. And so they're heavily in China. There is nothing, though, that we could invest in outside of gold, that not crypto, not oil, there's nothing outside of gold really that is not touched by China. In other words, all of your US companies are absolutely going to have problems if the supply chains from China dry up because they have an economic collapse over there. And this bank reconciliation for China has been coming for 20 years. This is a 20-year problem in the making. So it is going to have a contagion effect in the United States. And there is nothing outside of specifically gold that we could invest in that will not be affected on the US side from the match of the Chinese problem. China's doing its best to get something straightened out and to not overpromise, which is what they've been doing for 20 years, allow some players to fail without trying. It's the line. Where do we draw the line? Allowing some to fail, but yet not fully engaging the China to keep propping up their society artificially, which is what they've been doing for 20 years. So they have a reckoning coming, and it will affect us. The question is when. The question is always when. We are not market timers. So what I would tell you is that we are tactical managers and we do make boots on the ground changes all the time. You guys have seen it. However, right now, what we've done is we're in pretty overall conservative overall total positions, and we can lever between, a 15% net max downside, which is majority of our portfolios are under that, to as little as 7. But there is no reason to panic. So let me just keep everyone calm. We are in this for the long term. We build your financial plans with support in the walls and the roof, so that when the roof has problems, the walls sustain us, and that's in all of your plans. So keep in mind that we have you highly structured so that you have ultimate success mathematically. But we are aware, we are tracking, and we are certainly on top of everything. I want to say too that I'm expecting some major things to happen in the month of October, and I am all about what's happening in the month of October. So I just want to reassure you that everything that we can have our hands in, the knowledge that we have, the trade publications that we read, the amount of material that I read on a daily basis to have a pulse, the tracking that we do, the technical analysis that we do, we are on top of this for you. That's our job, so that you don't have to worry. That's not to say that we're not going to lose you any money when the market has issues. The market is what the market is, but that's why we have planning behind everything that we do for you, that we have an alternative if we need to let the market breathe and recover. So we're on top of it. Don't want to scare anybody. I just always share with you all the stuff that's going on, because I feel like that's what you want from me as your advisor. You want someone who is, boots on the ground in the economics, in the international, in the everything that's going on in the US, the Fed, the everything. And I have all that information, and I like to sort of just share it with you, and I don't mean to scare you, but the truth is we are in a very precarious market-based time. And I have been telling you since probably June, July, that I'm expecting a correction to the downside this year. Absolutely this year. And so we are aware of those circumstances, and we are watching those circumstances. But if you believe that you are too aggressive and you would like to go more conservative, just call us and we're happy to move you more conservative. The most conservative, of course, is moving to cash and holding in cash until we see that the 200-day and the 50-day for 3 months in a row are out, and then we know we're past the route. There's some technical analysis for you, but what I'm trying to say to you is we don't believe in moving to cash because, one, we interrupt compounding, and two, we don't have the right timing. Nobody is the right timer. Warren Buffett, as I've told all of you, Warren Buffett lost 48% when the market lost 49 in the dot-com crash, and Berkshire Hathaway lost 50.7% when the market lost 57 in the Great Recession. Nobody times the market correctly, not even Warren Buffett. So we want to stay invested, but we will pull back if we need to. We also don't want to pull back not only because of not interrupting your compounding, which is an issue, but we also don't want to incur any kind of capital gains for those of you that are looking for long-term investments. You're not looking for capital gains. However, that being said, we do not allow the tax tail to wag the investment dog. We have to make the investment decisions that are best for your investment, even if they come with tax consequences. So while we look at tax consequences and we consider them, we do not ever decide purely what to do on a tax consequence basis unless you have relayed to us that that's what you would like us to do. So again, if something is really coming up and the market is really starting to act much up a lot, the VIX index is how you can really see where the market volatility is. We are on top of it and we are protecting you. And if you think that since our last meeting, you need to be more conservative than what you formerly were because I'm telling you that there's a correction coming, then by all means, call our office, email us and say, I want to move my risk profile down to more conservative, and through the end of the year, we can and we will do that for you right away. We're happy to do that. Otherwise, we're doing it based on when we see the timing is necessary to go ahead and move. But for the most part, I would say everybody has about a 15% buffer where we're not trying to lose more than 15% get under any circumstances. Although the market is the market and we could always have a black swan event. And that would be a concern. So we're on top of it. We're looking at it. China is going to have a reckoning. The question is how fast and how deep and how much will it impact the U.S. But it will absolutely impact the U.S. There is no doubt. As far as what's going on with this legislation and this infrastructure bill, we have a little bit of pressure off because they basically agreed to fund the government through December, but we still have to have a debt ceiling vote. And that's where we really get to see, are they going to really pass an additional trillions of dollars? And don't think if they come back and say, oh, well, 1 trillion is what we're going to go with, and that's good, that's some kind of, like gift to us. Because they started at 5 trillion. That's psychological. They do this on purpose. If they had come out from the beginning and said, you guys, we just spent $8 trillion to fight Corona, and now we'd like to spend another 1 trillion on infrastructure. If they had presented it that way, I think America would be infuriated. But because it was presented as 5 trillion that maybe we might be cut down to 3 or 1, people are going to feel like they got some kind of deal. It's not a deal. It's not a deal at all. It shouldn't be happening to the level, to this extent, right after a virus. We have 10 million job openings. We need people to get back to work. We need people to start going back to whatever level of normalcy we can have during still a virus. And so that's a lot of economic facts are going into that. And those are things that we don't know. But I want to say I'm fully expecting October to be full of surprises, October surprises that aren't really that much of a surprise. And so we are on top of these circumstances. We are in it every single day. And this is what we're doing for you. And if at all you ever feel like I want to just be more protective and a little more safe, and Rebecca's not moving me fast enough to more security because I am really trying to keep us with growth until we start to see the corrections going the other way, then just call us and we'll be happy to make those changes. So that's pretty much the market update. September wasn't great. We expected it not to be, and it wasn't. And for now, we're on track. October, November, December, we've got 3 months to go to finish out 2021. It's gone by really fast, but we're here for you guys. And anything you need, please always call us and we will take care of it. Thank you guys. Take care and hope you have a great beginning of October.